Welcome back, everyone, to another episode. Today, we're going to be filtering through all the noise right now in the market, all the rumblings of whether or not there's a crash coming in the housing market, and really dig into why or why not this might be. Let's get started. Welcome back, everyone. So, look, if you're not on the news, then maybe you don't know. Or if you're living under a rock, then maybe you haven't seen all the big names talking about this crash, right? You see people like Robert Kiyosaki, who has really over the time almost turned into a conspiracy theorist to some degree, but he's talking about the biggest meltdown in history, arguably for his marketing, but who knows? You have Ken McElroy, who's really well known, a savvy investor. He's got a great new podcast. And I just watched a video of his that is somewhat shocking. Kind of just, just misleading people to some degree. This guy, Meet Kevin, famous among millennials, again, very young in his career, doesn't have a plethora of experience, but he has his own takes. And you have a ton of these little gurus, if you want to call them that are talking about a crash. But frankly, they're talking out of their butt. They have really nothing, no stats to back it up on, and they don't really understand the concepts of economics and how that relates to the asset class that is real estate. So I saw my good friend Michael Zuber talk about why he thinks it's not going to be a crash, and a lot of what he says is spot on. So if you haven't seen that, go over and check out his video, but I'm not going to reiterate what he said. I'm going to layer on top of that and talk about why I think there's not going to be a crash. And it's definitely a controversial viewpoint, as everyone is taking the angle of a crash because it seemingly might happen, but the numbers don't say so. And let me just tell you a few things. If you look right now at the big thing, which is forbearance. If forbearance goes away, there's an estimate of somewhere between 3.5 million to 5 million homes or homeowners that might be at risk. Now, that's an interesting number, okay? There's another number, 2.5 million, the amount of shortage that we have in supply, okay? And that's going to be over 3 million after this year. So there's a shortage of supply of about 3 million, give or take, and there's a potential for 4 to maybe 5 million homes in a wave of foreclosures. So we would be, in that theory, if both things happened, if we have that supply shortage and we have the foreclosure crisis that were to happen to the max, we would have a 2 million home overcapacity. That would put us at around a 9 to 12 months worth of supply. Now, a buyer market tends to shift, or said another way, when markets become favorable for buyers, less competition, price decreases, longer days on market, better deals, it tends to be above 7 to 8 months. 6 months is about a healthy market. 7 to 8 months of supply is when it shifts towards the buyers. So at a gap of 2 million, which is what that number I just said is, we're looking at 9 to 12 months of supply. Okay. Now, that's not a enormous supply to create such huge numbers that I'm hearing these gurus talk about, which is 40, 50% corrections. It's just bananas and makes no sense. But here is what I think might happen, okay? I actually think a lot of the markets that have, as I always talk about, solid fundamentals in their economy, they have a diverse economy, they have a growing population, they're benefiting from the COVID population migration, and just generally, they have a lot of just GDP growth relative to the nation over the last 10 to 20 years. If they have these strong, pretty basic fundamentals, someone needs to help me understand how a massive correction in real estate assets are going to happen in those markets. And there's a number of these markets. You have Denver, you have Austin, you have Phoenix, you have Nashville, and there's a ton of others, okay? So generally, I'm looking at this as, okay, there will be pain, absolutely. There's going to be its own pain within New York and probably Miami and San Francisco and Las Vegas, absolutely. And there's going to be pain in the C and D class, where I think a lot of these foreclosures are going to happen. And third, I would say a lot of the pain is going to happen in economies that don't meet the parameters that I use in my, my process for choosing properties. So think about this: markets that are heavy in hospitality, like Vegas, Florida, a big chunk of Florida caters to the boomers. They're heavy in entertainment. Again, Vegas, Florida, places where people go to have fun, more or less, and also economies that are backed with tax revenue driven by commercial real estate. New York, right? These are the areas that have the most risk, right? You're going to have higher default rates in these cities. You're going to have more pain. The industries are too concentrated, and they're going to see the hurt. That is true. But what is not true are these broad sweeping statements that, generally speaking, NAR, or the National Association of Realtors, and all the real estate tied to that are going to plummet 40 to 50%. That is the dumbest thing I've heard probably through 2020. Okay, so I actually believe that if you're picking the right markets like we have consistently done, and if you are buying in the sub $250,000 price point and renting them out and they cash flow, you're probably going to be okay. In fact, I actually am estimating a 7 to 10% appreciation rate in a lot of the markets that I have been chosen, or that I have chose. And so I actually put a bet on Ken McElroy, and I said, Ken, I will bet you $1,000 to the charity of your choice if I'm right, or if I'm wrong. If I'm wrong, I give you the money. If I'm right, you give me $1,000 towards the choice of charity, or charity of choice of my choosing. So I don't know. We'll see if he takes it, but there's a lot of numbers that just don't make sense for a looming crash. And I think what's going to happen is people are going to have on the sideline all this cash, and they're actually going to get bit from inflation, and they will have wished that they had bought and not listened to all the herd noise that is out there right now. So again, I know this is a controversial topic, and I'm happy to entertain any other comments or ideas that you all might have to prove me wrong. So someone, please prove me wrong, because right now I'm investing in these markets and in these asset classes because I believe there's good things ahead for real estate. So if you like what you heard, hit the button. And again, be sure to subscribe. We have a lot of cool stuff coming out here in the next few weeks. So until then, thanks y'all.